today's episode, I'm going to dive into a little bit more about what a mortgage lender is. We still have Jamie here too, though.
Yeah.
So what is a mortgage lender? Mortgage lender is who is going to finance your home, similar to like if you get a car loan, you go to the bank or you go to a dealership, but they don't really make house dealerships. So they have mortgage lenders. You get pre-approved early on in the process. One of the biggest misconceptions that buyers have is that they need to be pre-approved ready before that they should talk to a mortgage lender, but that kind of defeats the purpose. Like our whole job is to help you become pre-approved. And so you talk to me, we go over your 2-year work history, your 2-year address history. We do a soft pull of credit only, so it's not going to have any hard impact to your credit. And the application doesn't expire like a bank or a credit union. So we can work on the pre-approval for as long as it takes for you to find your home, even if it's years. You're basically just thinking of it as like creating a social media account, and you've got your info in there, and as time evolves, you update things like if you change a job or have a new bank account you want to add in. It just allows us to work on it until you become a homeowner. And in terms of credit building, you want to make sure you have a credit card and not spend more than 30% of the card's limit. If you don't have any credit cards at all, you can always get a secured credit card from a bank or a credit union, and those will build credit just the same. But one of the really cool loopholes is that if you have a relative or a friend who has a credit card that's had a long history of it being used responsibly, meaning under that 30% of its limit, you can get added as an authorized user super easy online through an online banking account. And you basically overnight become an owner of that credit card since its inception. And so you look like you've had a credit card for a very long time and that you've been using it responsibly, and your credit can skyrocket. So that's a really quick way to start building credit, but you can always do it yourself through getting your own credit card as well. In terms of auto loans, definitely don't try to get an auto loan right before you buy a house. If you already have one, that's one thing. Just keep paying it. But it's a lot harder to get pre-approved with higher debt. And so if you can, do it the opposite way and just get the house first, and then you can go out and get a car loan, because it's incredibly easy to get a car loan and it's a lot harder to get a home loan.
Yeah.
Down payments, you don't necessarily need to have a down payment at all. There's 0 down payment programs out there.
Which is one I used when I first bought.
Did you?
Yeah.
You said it was
USDA.
Oh, it was USDA.
Yeah.
I thought maybe it was FHA 0, but USDA.
FHA, USDA. Yeah.
Cool. Yeah, there's 0 down programs out there. There's a ton of 0 down programs. They'll have their drawbacks though. So if you can come up with a minimum of say 3 to 5% down on a home, that's really ideal. But it shouldn't be a deal breaker. Definitely worth talking to a lender and seeing if a 0 down program's a good fit for you. If you have less than 20% down, however, you're going to have what's called mortgage insurance, and it's different than homeowners insurance, where it only protects the lender in the event that the home goes through the foreclosure process. And it really is compensating for the legal fees that they incur when they have to go through a foreclosure process. And your total payment, you'll have the mortgage insurance as a component of your monthly payment. You'll have your principal and interest as your monthly payment. And you'll have homeowners insurance that protects the property, and you'll have property taxes. And property taxes will generally go up every year. Your insurance can as well, but it's rare to see property taxes go down. So another fun fact is that even though you have a 30-year fixed mortgage, your payment, you can expect it to still go up every year solely because of property taxes. It's not because the lender changed anything with the loan. The loan's still going to be a 30-year fixed, assuming that's what you get put into. So insurance, homeowners insurance, you can always change that too. You're not locked into that for the whole 30-year period. So if you get a better deal, say through switching to Geico, you can always switch insurances during the life of the loan. As long as you let the lender or the servicer know, you don't want to have a lapse in coverage between switching from one insurance to the other. Then we'll dive into closing costs, because along with down payment, you want to factor in closing costs. Sometimes you can have a seller credit cover those, but you don't want to rely on that solely. So plan for closing cost to be roughly between $7,000 and maybe $13,000, depending on the property. And what the heck are closing costs? Those are lender fees. You'll have title and escrow fees. That is the third party service that will record the sale with the county. And you'll have an appraisal that's generally about $800. And you'll have 1 year prepaid taxes and 1 year prepaid of homeowners insurance. The taxes and insurance are generally included in your monthly payment. The only option to not have them in your payment is if you were to put 20% or more down. But as a first-time home buyer or even a second-time home buyer, like, it's really rare to see somebody have 20% down, especially with home values the way that they are. Like, that's just a lot of money. Then you'll have the home appraisal in there. What that is that's going to determine your home's value. It's different than the home inspection. That is going over the home. Jamie will dive into that.
Yeah.
That's her forte. But the appraisal inspection is really looking at comparable sales in terms of the square footage, the quality, and determining what they think the home is worth. And the home has to appraise for what the sales price is. If it's not, then you're responsible for coming up with a difference or negotiating with the seller, or you're able to walk away. But you don't want to buy a house and be upside down in it. So the appraisal is really protecting you and the lender who's lending the money. So for a 30-year fixed loan, you're not necessarily in that loan for 30 years. You're able to refinance to a lower interest rate if rates come down. You're able to refinance if you want to pull cash out and you've got the equity to do it. You're not stuck in that property for 30 years. Heck, most people don't even own their homes for 30 years. They, on average, I want to say they own the home for about 7 years. And as a first-time home buyer, people think, oh my gosh, it's so scary. I'm getting into a mortgage. It's such a big deal and responsibility and scary. But really, if you just look at it as like a 2-year rental agreement, I say 2 years because capital gains tax is something that you're responsible for paying if you sell your home before the 2-year period is up. And to my knowledge, I'm not a tax expert, it is tax that's on the profit of the home, assuming that the home is appreciated in that 2-year period. Most homes do appreciate over time. So if you can at least just keep the house for 2 years, it's really like a 2-year contract if you think about it.
Yeah.
So you'll have different lenders. There's, a bank, a credit union, an online lender such as Rocket Mortgage, and you'll have a direct lender such as myself. The main differences between them, banks and credit unions are much harder to get pre-approved through. I know because I used to work at them. And direct lenders are easier to work with. Online lenders are not meant for everyone. They are easy to use because you can just do it from your own home. You don't meet with anybody. But you don't really know who your lender is, like on the other side of the computer. And oftentimes local listing agents don't like pre-approval letters from an online lender versus, say, a direct lender or a bank, because they don't have somebody to hold someone accountable. And the big online lenders generally don't work super hard if a transaction is difficult, if the buyer's hard to get pre-approved, because they have so much volume coming in that they essentially can cherry pick who they want to work with.
And they don't necessarily fully pre-approve somebody. And some of those loans will fall through, and then they have to rush to get a local lender anyway. It's always best to use a local lender.
But yeah, buying a home is the biggest purchase of your lifetime. unless you're like Warren Buffett or something, I don't know. But generally, it's one of the biggest purchases of your life. And so you really don't want to put your pre-approval on the purchase side of things in unreliable hands, like maybe an online lender. Um, the rates might be better for certain lenders, but also keep in mind that that doesn't necessarily make them a reliable lender. And so I like a general rule of thumb, it's safer to go with somebody who's super reliable on the purchase side of things. If you want to refinance to a lower interest rate down the road, go with a cheap lender at that point. It's just a refinance. But don't risk putting the home in jeopardy by going with just a cheap online lender.
Yeah.
Banks and credit unions, they're different because not only are they harder to get pre-approved with, but they're not available 24/7 like a direct lender. And so if you need a pre-approval letter on the weekend or at night, or to have questions answered about a specific property, you're not going to get a hold of them except for the 9 to 5. And that's assuming that the banker is even free. A lot of times you've got to make an appointment with them because they've got their day booked with other appointments.
Mm-hmm.
So an online, like a direct lender, is generally the most reliable, would you say?
Yeah.
In like your experience?
Yeah, for sure.
And speaking of interest rates, the rates, of course, are higher now than they have been in the COVID era, but historically, they're still insanely low. And when people complain about a 6 or 7% interest rate, it always makes me laugh because they're renting, and rent technically is 100% interest. And so I would much prefer a 6 or 7% interest over 100% interest, because at the end of the transaction and you go to sell your home, you make some money. You're not going to get money back when you close out a rental contract.
Yeah. No. Maybe your deposit.
Yeah, maybe
if you're lucky.
So if you can, it's always to build wealth through a home ownership is incredibly easy and rewarding, and I don't know anything about renting that's very rewarding. So it's always good to look at it as a long-term investment, and it'll pay off in the end.
Yeah.
The deceptive lending that took place back in 2008-ish, I wasn't a lender back then, but there wasn't any safeguards to protect buyers. And to my knowledge, there was a lot of predatory lending going on. And so since that, they've created a lot of guidelines and restrictions, and it's a lot harder to get pre-approved now. So people who used to buy a house, 30 years ago, they get frustrated with how many hoops they have to jump through, but it's really to protect the buyer.
Yeah.
We can't put somebody into a loan that they can't afford. And we're accountable by auditors, and you can't afford a home with a certain percentage of your debts to exceed your income. So just know, lenders these days, we can't put you into a home without a job or without income or just stated income. You actually have to document that you've got legit way to pay this mortgage. And I think a lot of parents of Gen Zers, they went through the crash, and so they're really scarred from it, and therefore have taught their kids that lenders are bad people, because back then they were bad people, but things have changed, and lenders are not out to sell you a home that you can't afford.
Yeah.
And servicing of your loan after the loan closes, why that matters, I'll dive into that a little bit, because 99% of banks, credit unions, and lenders, they'll sell your servicing to an online servicer or to a big bank. And it's frustrating not only because you have to change your loan number and your online bill pay, but they're also not going to make the refinance process very easy for you. Whereas a direct lender like Guild, who holds the payment, they have your escrow set up with that taxes and insurance account that we talked about. They'll have that already in place. And so it's incredibly easy to roll everything over where they don't have to create a new impound account. And you've got that relationship with that lender for life. So they already know your whole history, and going back to them, it's a lot easier than trying to form a new relationship with somebody you don't know, starting the application process all over again. And you'll have to create a new escrow and impound account, which can be quite expensive depending on the property. So, working with a lender, try to make sure that they do service their loans, or at least most of them, and it will make your life a lot easier down the road.
Yes.
And for me, that is a wrap.
All right.